Our next speaker is Mr. Brian Rogers. And after many years of practicing business law with major law firms, Brian left a thriving practice to found Blue Maven Law. And Blue Maven Law is a firm that is dedicated exclusively to small business owners. He saw an opportunity to provide first-rate, experienced lawyering to help small business owners achieve their dreams safely while navigating all areas of the law that apply to their business. Today, he's going to help us all by sharing how to start 2026 protected. Please welcome Brian Rogers.
Thanks, Kara, for that introduction. I assume you had something to do with a few of those words. I know I didn't recognize them. So this has always been one of my favorite groups to speak to. So I've been looking forward to this for a while. And some of my close business friends are here that I haven't seen in a while. So it's an extra good treat for me. So start protected in 2026. So as few as 50% of restaurant workers wash their hands. I'll try not to let that sink in too much, but I first heard that statistic in a presentation, and the presenter was an entrepreneur, and his business had some sort of restaurant hand washing monitoring system. And so they monitored the employees, and this is what they found, which was a little scary. So hand washing is well known to be one of the most effective ways of spreading disease. Of course, it's especially important in a restaurant, but it's, very cost effective. It's free. It doesn't take long. I used to think it took a few seconds, but since the pandemic, I know it takes 20 seconds, but it's still free and it's easy. And the idea for this presentation came to me last fall when I was thinking back on the previous year and some things that we've helped our clients with over the past year. And a lot of these things really amount to what I'm thinking of as bureaucracy hygiene. Easy things, cost-effective, like hand washing, that if left undone could lead to bad consequences. And a lot of what we did for our clients was just helping them fix the issues that arose from not taking care of these few hygienic habits. You don't know what you don't know is one of the scariest truths in life and business. If you know what you don't know, it's usually pretty simple to, go to ChatGPT, Google, a professional, and figure it out and take care of it. But when you're blissfully unaware of something that you don't know, then there could be danger lurking ahead that you're just unaware of. So, and then here is a picture of one of the good people washing their hands. So there's 4 different types of issues that we're going to talk about today. The first is reinstatement after a company's been administratively dissolved. There's a number of reasons that can happen. The second is not letting the Department of Revenue know when a company no longer has employees and they quit filing their payroll tax returns. The third is not being qualified in jurisdictions where a company starts doing business. And then the last one is payroll tax frequency. The Missouri Department of Revenue requires companies, if they're very small, to file payroll taxes annually. As they grow, often they're required to do it quarterly. So first, reinstatement. So for a number of different reasons, Missouri corporations and LLCs can find themselves administratively dissolved, which is really a really bad position to find yourself in. The fix is usually pretty simple. You fix the underlying problem, you file for reinstatement, pay usually a fairly modest fee, and everything is good. And your reinstatement date relates back to the date of dissolution. So in some senses, it's as if nothing ever happened. Although in the meantime, the owners of the business have more potential personal liability than they realize and than they should. So there's 3 different reasons that our clients in 2025 found themselves administratively dissolved. The first one, we have clients every year that find themselves in this position, and that is they don't file their annual or biannual report with the Missouri Secretary of State. And Missouri corporations are required to file a report every year. It's a simple report, doesn't take very long, just reporting their directors and their officers and paying a small fee. But inevitably, for a few corporations every year, this falls through the cracks and they don't get it done. Eventually, they're administratively dissolved. Fortunately, limited liability companies don't have reporting requirements in Missouri, so that doesn't happen to them. But if you have a corporation, pay attention when you get that letter from the Secretary of State saying that you need to file your report, because if you don't, you can file yourself administratively dissolved. The second reason is far less common, but that's administrative dissolution for failure to maintain a registered agent. Now, every corporation, every limited liability company in Missouri is required to have a registered agent. And the purpose of the registered agent is to be a point of contact for the public. So for instance, if someone needs to sue a corporation, they serve process on the registered agent. If that registered agent's nowhere to be found, or if the registered agent resigned and wasn't replaced, then the company could be administratively dissolved. So I would encourage all of you, I've seen so many times where people form their LLC by themselves or maybe hire an attorney or their corporation, and then they never think about it again. And since Missouri LLCs aren't required to file annual reports, you're just not used to thinking about keeping stuff up to date with the Secretary of State. The attorney, retires, moves, whoever the registered agent is, it gets out of date, so they can't be found, and that excuse me, that could be problematic. So you can check your own status by going to sos.mo.gov, search for your company, see who the registered agent is, make sure the address is up to date and the registered agent's up to date. So, and then the third one, I always knew was a possibility, but I'd never seen this in the wild, and an LLC died of old age. I'd never seen that before. I knew it was a possibility, but so LLCs were invented in Wyoming in 1977. In 1997, the IRS enacted what's known as the check the box regulations. And in that interim period between 1977 and 1997, in order to make sure LLCs were not taxed as corporations, they had to have a limited lifespan. And so they had an end date in their articles of organization. I think the idea was, sometime before that end date came, they would amend the articles and all would be fine. Well, it fell through the cracks for one of our clients, and they found themselves administratively dissolved because their LLC had died of old age. So again, all these things were easy to take care of. We just fixed the underlying problem, filed for reinstatement. Clients paid relatively modest fee, and that was the end of it. But you should be aware that these are possibilities for your own business.
Does that apply to all states?
Every state has those for the LLC or
The diet of old age thing.
yeah. So from 97 on, almost always. Does that mean I have 10 minutes left, or I've?
Yeah.
Okay. I was about to say, we're going to speed up. Time flies when you're having fun. Yeah, so if your LLC was formed before 97, then there's a good chance that the LLC would have an end date. But in no matter the state, every state was that way because it was federal tax law that was driving this. So basically, when LLCs were invented, the idea was to combine the limitation of liability characteristics of a corporation. Corporations basically protect their LLCs from the business's obligations with pass-through tax treatment that you would see with a partnership or a sole proprietorship. And the way the tax law was at the time, they had to make sure that the LLCs did not exhibit too many characteristics of corporations. One of those was continual existence, so they had to have an end date. And so that was nationwide. So, okay, the second is failure to let the Department of Revenue know that you no longer have employees and just stopping filing your Forms 941, your payroll tax stuff. And there are two situations that we commonly see this, and we see this every year too. And what happens when you quit filing and the Department of Revenue thinks you should still be filing is that they will charge you, I think it's a $200 fee for every report that you don't file, plus interest. And so it can obviously add up. Now, I will say that the Missouri Department of Revenue, we found a lot of success with our clients getting them to waive these fees and things. So for the most part, in the end, our Department of Revenue issues with Missouri have worked out pretty well for our clients, even though these things can be pretty stressful and costly to just work out. So the first circumstance is a company sells its business, no longer has employees, and so they quit making their tax filings. And then the second is that they've engaged a professional employer organization or PEO, someone like Insperity, and they don't realize that they need to let the Department of Revenue know that they don't have employees anymore. So let's talk about the first. This is my favorite stuff, getting into the weeds a little bit of how deals are structured. So everyone take a nice sip of coffee to wake yourselves up for this. So this is a kind of a diagram of before a business is sold, the situation. So the circle there, the buyer represents an LLC or corporation, and it has cash because it's going to pay cash for the target's business. So the target, the circle, represents the entity itself. In this case, it's a corporation because it has shareholders, but it might be an LLC. It's got all the business assets and it's got some liabilities. So there's a number of ways of structuring a business transaction, a business sale, but by far the common is an asset sale. And here's a diagram of what actually happens. So the assets are transferred from the target business entity to the buyer entity and then cash. And so the end result is all the business is in the buyer, all the assets, and then the target has cash and often is still responsible for its bills and other liabilities. It'll distribute the cash to the shareholders. And so in that process, all the target's employees are terminated and then they're hired by the buyer entity. So the seller entity, the target entity, no longer has employees, and often they'll stop filing their payroll tax returns, and they'll get a letter from the Department of Revenue saying you owe us some money. So that's one instance. The other is a little bit, it feels weird to me, but the whole situation is weird with PEOs. So I don't know if you're familiar with PEO organizations, but basically they're companies like Insperity that they pool really large groups of employees, and so that they can offer health benefits, health insurance and the like, to smaller companies for an affordable price. And what's weird to me about them is, hopefully that didn't, what's weird about them is that when there's a PEO arrangement, both the PEO and the company are the employers of the employees. So they're co-employers. So for some, in some respects, the company is the employer, and in others, the PEO is the employer. So the company basically transfers money for every payroll over to the PEO organization, who then makes payroll, does the payroll tax filings and all that. And so the company no longer has tax filing obligations, payroll tax filing obligations, because they don't have employees. That is, as long as they let the Department of Revenue know they don't have employees anymore. So a lot of times there's a disconnect between the PEO and the company that report doesn't happen to the Department of Revenue. And so there they go. So the third is really common also, and it's foreign qualification. So every corporation, every limited liability company, if you do business in a state other than the one that you're organized or incorporated in, you're required to register with that other state as a foreign corporation or foreign LLC. And a lot of times, business owners just are not aware of this requirement for the most part. And so they can, a business grows, you start selling product into other states, you open up a new location, you hire an employee in another state, and those two things are generally going to trigger your requirement to qualify. So, and the two main things here are location, represented by a little office building there, and then people. You hire some people in another state, and you're probably going to have to register. Now, in most states, like I mentioned, the Missouri Department of Revenue, you can fix it. If you realize, you find out that, you've been transacting business in, say, Kansas for a few years, they'll work with you for the most part. It'll cost a little bit and some fees. You got to register, but it's no big deal. Unfortunately, on our other border, Illinois, they are not, they don't work with anybody on these sorts of things. And it can be really, really expensive. We had a client last year whose company had been transacting business in Illinois for decades. And it was really expensive. And the Secretary of State would not work with us to help with that. So, and then the last one is filing frequency. And this company, as I mentioned before, often companies will start out with very small payroll, and so they're annual filers with the Missouri Department of Revenue as far as their payroll tax filings. But as they grow, they'll be required to file quarterly. And so this particular company didn't get the memo for some reason. 3 years later, they got a letter from the Missouri Department of Revenue assessing late fees and penalties for 3 years of not filing because they were filing annually. So this company thought they were completely in compliance. They were filing, paying all their taxes on time. But for every year, there were 3 returns that weren't filed. So there's penalties for that. And it's surprising how quickly interest can accrue when you pay at the end of the year something you should have been paying quarterly, and then compound that by 3 years. So again, the Missouri Department of Revenue worked with us, and in the end, this company filed the returns and they didn't have to pay penalties and interest, but it was no fun for them in the meantime. So you don't know what you don't know. Bureaucracy, hygiene. I know this has been a lot of fun for everybody, like it was for me. A lot of interesting topics, but if any of these could be an issue for you, I definitely encourage you to hit ChatGPT, hit Google, and maybe hit up a CPA or an attorney if you need to. So, and there's my little diagram of annual versus quarterly. So, oops.